Hi, I'm Sharon Winsmith, a tax attorney, active investor, and your go-to resource for proven investment and tax planning strategies. In this video, we're going to talk about if you should do the buy, borrow, die strategy or just pay the tax. So if you're not familiar with the buy, borrow, die tax planning strategy, I'll link to that below. My crash course video where I explain kind of an intro of what the strategy is. This is, in my opinion, the best tax planning strategy. Really, anyone can do it as long as you understand what the strategy is and how it works, and also the risk you're undertaking with, using a loan to borrow against your assets. So with that said, I am a big fan of buy, borrow, die. When someone, makes a critical comment about it, I kind of feel it, I take it personally because, I think buy, borrow, die is the most important strategy out there. It is great in the sense that it couples, good disciplined long-term investing. So it keeps you really disciplined as an investor, and it has, great tax benefits. So in addition to just the investment side of things, it's great on the tax side of things, and it allows you to own assets that you can own for life and just kind of leave and, not have to really worry about that much, and then pass them down efficiently to the next generation. So I think buy, borrow, die is great. I see a lot of things said about it that are wrong. So one of the things I see, when people are being critical of buy, borrow, die is they say, well, it's better to just pay the tax and then to leave the loan outstanding for a long time. So that is actually not true. And when people say that, they don't really understand all the benefits and exactly how buy, borrow, die works. So let me just walk you through a really quick example to illustrate why that's wrong. So I'm going to take an example where, and I'm using really small numbers here. I just, like to make it easy so things shake out nicely and you can kind of see what we're doing. But I put together this basic model and, I'm going to assume a fact pattern where I've built up a stock portfolio. I'm just going to, say I have 2 shares of stock that I bought years ago at $25,000 a share. It can be, whatever you want it to be. Of course, you're not going to pay that for one stock, but just to keep the example simple. So I bought 2 shares of stock a long time ago. I paid $25,000 each for the shares. So my cost basis in those shares is $50,000. I'm looking at this today, and the current fair market value of my stock portfolio, which is still just those 2 shares, has now gone up a lot, and it's worth $100,000. So this is not, an uncommon fact pattern. Yeah, a lot of our stock portfolios might not have doubled. It just depends on the time frame of how long you've held it. But if you've been an investor in the stock market for a long time, you're going to have significant taxable gain, in the appreciation in the stocks in your stock portfolio itself. So my total taxable gain in this situation is $50,000. So if I went out and sold those shares to, get some liquidity, then I've got to pay tax on $50,000 of gain. And that's not great, right? Because you're paying a big chunk of that over to the IRS. So I'm just going to assume a basic tax rate of 30%. You've got the 24% federal with 20% capital gains tax, the Obamacare tax, and then I'm just going to assume, a modest state tax on top of that. I'm going to assume that the stock investments, typically get a return of 10% on every year. So that is the average. There may be some years that it's less than that, but there's going to be, other years where it's more than that. So that is the average return. And that's just based on the S&P 500 and how it's performed in recent history. That's, again, I think I'm being very conservative with this modeling. I'm going to assume my SBLOC interest rate is 5%. So I'll link below to what an SBLOC is in case I've lost you here. But an SBLOC is basically a loan I'm going to take against those shares. And you'll see why that's important in a minute when we go to the borrow part of buy, borrow, die. So I'm using a 5% interest rate. If you're watching this video at the time I'm recording it, interest rates on SBLOCs are a little bit higher than that, but historically they're significantly lower than that. So I'm looking at this on average. You want to model it short term for cash flow needs, based on the rate it is currently, but I'm using 5% to be very conservative. In the recent history, I was paying less than 2%. So really on average, your SBLOC rate is going to be a lot lower than that on the long-term basis, but I'm just going to use 5% for purposes of this model. So let's say we have a fact pattern where I need $42,500 to go out and buy something. I don't know what it is, a car, whatever it is. So I need to get that money. I don't have another source of income for it. And so, my only option is to sell my shares. So I'm going to walk through a scenario where I sell enough stock to get my $42,500. And then I'm going to walk through a scenario where instead of selling stock, I do buy, borrow, die, and I borrow against my shares by using an SBLOC. So let's look at scenario one, which is a taxable sale. And let's talk about what it would look like as far as our net worth at the end of the day. So I need to sell one share, right? So I only need 42,500. So I'm just going to sell one share. My basis in that one share is $25,000. So I've got a $25,000 taxable gain. I've got to pay tax on that $25,000. So I've got to pay over $7,500 to, the government. So that's just a lost cost there. And my after-tax proceeds, when I take the $50,000 that I made from the sale, less the tax I had to pay, there's my $42,500 that I need to go, buy my car or whatever. So if I were to have just done that, if I were to have just sold one share and kept the other share, let's look at what that would mean as far as my net worth. So the $42,500 is gone. I'm not even, using a scenario where I'm taking that money and investing it in a secondary asset. I'm just assuming I'm using it to pay for personal expenses. So all I've got as far as, what my net worth looks like is that one share of stock left. So that one share today is worth $50,000. It makes 10% gain every year. So at the end of that year, it's worth $55,000. So I've modeled this all the way out 20 years just to keep it simple. And at the end of 20 years, my one share of stock is going to be worth a little over $330,000. So that is my net worth. And, I poof went the $42,500 because I spent that and I lost that share, right? So I only own one share now. I did own two, but because I sold one, I've only got one asset left. So people who do not understand how buy, borrow, die works will tell you that, that's better in the long term, especially when you're modeling this out 20 years, to have just paid the tax and sold that one share. Now, the reason that they are wrong is that you still own the underlying asset in buy, borrow, die. So if I look at scenario two, where instead of, selling the share, I'm going to go out there and I'm going to borrow against it. So my stock portfolio is still $100,000. I still own both of those shares. I haven't sold anything because I'm just borrowing against it. So I still own two shares of stock. I still have that net worth. Yes, I'm going to have a loan on that that's going to decrease my net worth, but we'll look at that in a minute and explain why that doesn't kick you into a situation where you are better off paying the tax. So when I look at my stock portfolio, we'll get to the SBLOC in a minute, but when I look at my stock portfolio, I am getting significantly, double the returns, right? So I am keeping that $100,000 invested and it's making 10% returns every year. In 20 years, that is, double. It's almost a little bit, it's almost $675,000 at the end of 20 years. But yes, I have, a loan that I owe, so that's going to decrease my net worth. So let's talk about what the loan would look like. So I needed $42,500. And, here's the SBLOC. I took that SBLOC. I'm able to take it because it's not, more than 50% of the value of my portfolio. Yes, I do have to pay interest on that. People always seem to get tripped up and get disturbed by that. When you take a loan, you do have to pay interest. You have to pay for the benefit of being able to access that liquidity. My annual interest is going to be at 5%. It is going to compound daily. I am not going to pay that interest. I am not going to pay down the $42,500. I am going to leave that interest in principal and let that interest keep accruing outstanding indefinitely. Yes, I know some of you may be shocked to hear that. I think some people are probably dropping down on the floor because it's so crazy to imagine that I would just leave, a principal unpaid and let the interest compound daily, indefinitely. But yes, if you do this in a way that you're not, you understand what you're doing. Yes, there's some risk associated with that, but you're still better off in this fact pattern because here is what it looks like on a net worth basis. So I've got my stock portfolio, $110,000. I've got my SBLOC that I own. And so it's the $42,500 I took plus the interest that's going to be added to that. A balance is going to keep adding every year. So that's why you're going to see, the balance get higher and higher. That's why it's going to get a lot higher than $42,500. But when I put these two together, here's my net worth. It's $65,000. So in year one, I'm still better off, right? My net worth is $65,000 because I still own two stocks. And, if I had sold one of them, my net worth is only $55,000. So if we go out 20 years, it gets even worse, right? So Whereas it was $330,000 if I sold the share, now my net worth is over $555,000. So this is a difference of over $200,000. And we're talking about really small numbers here, right? We're only talking about a stock portfolio worth $100,000 where you're borrowing, $42,500 to, do whatever you want with that money. So why is that the case conceptually? We can see here the model proves out that it's better. Yes, all the naysayers are going to say, but you could have a margin call. What happens if the market drops? What happens if the zombies invade and we all die? People are just going to keep throwing these ridiculous scenarios. Yes, you could have a margin call. That's a very, possible situation. You need to plan for that. I have a lot of videos on my channel. I'm not going to link to every SBLOC and buy, borrow, die video I have because it would just, I have tons, but I have ideas on how to, prepare for a margin call. I have ideas on how to, I show you how to calculate that so you can make sure you're watching that and monitoring that if you do see the market start to drop significantly. But with that said, a margin call is not the end of the world. And, look at the cushion you have. Here you've got in year 20, your stock portfolio is $672,000 and your outstanding SBLOC is only $115,000. So how much would the market have to drop really for you to have an issue? So, yes, that's a risk. Yes, there are a lot of good strategies to avoid that and prepare for that. But, I'm not going to let that stop me because I know what I'm doing. I don't listen to the naysayers. I listen to the people who are successful and they all, use this strategy. So this is the difference in net worth accretion. You can see how if you keep adding and taking more SBLOC in the future, how that could be much better. And also, the best way to use buy, borrow, die, and the way, a lot of people like myself, vast majority of the time are using buy, borrow, die, is to borrow against asset one to invest in asset two. So that is the double dip strategy. I'll list, I'll link to that video below because you need to understand that. That is the smart way to use buy, borrow, die. That is a way you can just use it in a way that you've got another investment on here. So you've got, your stock portfolio making money. Well, if you're doing double dip, you've got another investment that's going to just add to your net worth, keep growing over time. And the reason this works here, so just to make sure you understand conceptually why this works, is because the rate of return on my investment, the stock portfolio here, exceeds my SBLOC interest. And that should always be the case. I'm not saying everyone's stocks are going to outperform their SBLOC interest. If you are doing an SBLOC somewhere that has a high interest rate, like, Schwab or, E-Trade, somewhere like that, that's not a good place to do an SBLOC. You're going to pay a pretty high interest rate, especially right now when interest rates are higher. But if you do it somewhere smart, I like Interactive Brokers. There's other places that have lower interest rates. Then your SBLOC interest should usually be the lowest cost of borrowing available to you. It's usually going to be your lowest cost borrowing option, very comparable and in a lot of cases lower than a mortgage. Also, your stocks need to outperform the SBLOC interest rate. This should not be hard if you know what you're doing. On average, the S&P 500 index fund, is going to kick off about 10% returns. So, if you're making less than that, you're underperforming the market. So you maybe figure out what's going on there, but make sure you're looking at this all on an after-tax basis. But it should be easy if you're a smart investor for, your investment returns to exceed the SBLOC interest rate that you're paying. If you're going to use this strategy with a different asset than stocks and you're not talking about an SBLOC, maybe it's a business loan, you've got to always make sure that your returns on that underlying asset are going to exceed the interest that you're paying. That should not be hard to do if you know what you're doing and you're willing to educate yourself. But that conceptually is why this works. And the reason that people don't understand that, and understand why this works is that either they're just not great investors and not getting, a decent, modest return that at least performs at market, or they're doing an SBLOC at somewhere where the interest rate's too high, or they don't just understand the benefits and the concepts that underlie buy, borrow, die, which is that you keep owning the underlying asset. That is why this strategy is so great. You're going to own that asset and you're never going to pay income tax on the appreciation in it. So hopefully this explains why it's usually better to buy, borrow, die than to just pay the tax. And hopefully it gives you a little bit more insight into how the strategy works.